Minutes of things that I want to say. Today, to me, is about why and how. So allow me to start by answering two why questions before we get to the how questions. Why the heck did I organize this panel? And why should we respond to the SEC's request for public input? Answer number one. On March 15th, I had an oh my God moment. I listened to a speech by then acting chair of the SEC, Allison Herren Lee, about all the things the SEC is doing to climate and ESG, concluding with a request for public comments about how it should obtain disclosures that meet investors' needs. Oh my God. The SEC is serious and has the capacity now to implement mandatory ESG disclosure regulations likely this year. Answer number two, why did this excite me as much as getting my first vaccination shot? Simply, in my professional experience on Wall Street, disclosure matters. The prospect of disclosing information that could make one look disreputable changes behavior. Not always, but often. Also, it's hard to manage what you don't measure. I've been focused on impact investing broadly defined for the past handful of years and view this as an inflection point when investors increasingly will be able to evaluate impact of their investments as part of their risk and return calculations. So I've been all in since March in figuring out how to support this initiative at the SEC and how to wisely implement disclosure requirements. The SEC's request for input includes 15 numbered questions and many sub-questions, but one does not have to weigh in on all of them. Various environmental and other public interest groups will respond, but the SEC will value letters from investors more. Don't worry that you've never written a comment letter before if that's the case. We're going to tell you how. And we have wonderful experts to guide us. Our panelists' full bios are available by clicking on their names on the Impact Capital Forum event website or email invitation, so my introductions will be abbreviated. Our discussion will cover strategy, the top issues, and mechanics. And sample letters will be available to anyone who emails investorvoice@hwwimpact.org. I'll put that in the chat. HWW is High Water Women. I'm a member of their Accelerating Impact Committee. I'm also a member of Impact Capital Forum. As we go along, please use the Q&A function for your questions. We'll try to get to them and or respond by email afterwards. And I guess I need to introduce myself because Tatiana was going to do that. So I was a senior managing director at Bear Stearns until its demise in structured products. And I've worked in Washington twice, long ago for the Senate Banking Committee and more recently for the Financial Crisis Inquiry Commission. And I've had the good fortune of doing a bunch of other things, including participating with various impact investing organizations. So with that, I want to turn to our first panelist, Tyler. Tyler Gellasch is Executive Director of Healthy Markets Association, an impact trade group that focuses on transparency and costs in capital markets. His public service included 5 years as counsel in the US Senate, as well as service as counsel to the then new SEC Commissioner Stein. Ty is also a fellow at the Global Financial Markets Center at Duke Law School. And I think it's fair to call him a Washington insider when it comes to SEC issues, and many have been seeking his wise counsel on this SEC initiative. So Tyler, Why should we all write letters? And what are the top 2 issues that you hope investors will address?
Well, first, thank you. I appreciate the opportunity and the flattering introduction, although I'm not sure Washington Insider is flattering these days, but I will still take it. Full disclosure, then acting chair Lee's husband, Jay Brown, a securities law professor in his own right, was once on our board. And I had the privilege of working with Commissioner Lee in Kara Stein's office at the time. So full disclosure, I guess I do know a few people. Thank you so much for the opportunity. First things first. As we all know, the SEC at the beginning of this year, with the change of administration, they named an acting chair, and the acting chair did a bunch of things that is going to impact investors very directly, even before we get rulemakings. They created a division of enforcement task force focused on climate and ESG disclosures. She's looked for accountability in proxy voting, as we've all heard stories about large investment managers saying they really, really care about various ESG and climate things, and then maybe not voting that way. She's focused the division of examinations on those types of issues and proxy accountability. She also, as you noted, released this extensive list of questions. It's 15 numbered questions on March 15th. She's also given a number of speeches in which she goes well beyond just disclosure, but also things about shareholder rights, the ability to vote, and the ability to, for example, fire directors, something called universal proxy. She's talked about a lot of things that are related to what I would say corporate accountability across the spectrum of issues, and very specifically related to climate and ESG. So first things first, the list of 15 questions covers a few very basic topics, and I'll just sort of go overview. One is where and how to disclose. Should climate-related disclosures be in Ks and Qs, or should they be in a separate document? That's a really basic question, right? Another question, what's measurable? What's reportable, right? Like, what are things that we should get sentence answers for, and what are things we should get number answers for? Yes, no, or a number versus give me some pros that we can compare. And obviously a strong preference towards the numbers, right? Then the second question, so what do you want from financial firms? To the extent that you have investment advisors or banks or investment companies, what are the types of disclosures that we would think in those various businesses as they're looking at their own exposures for the operational companies in which they either may invest or they may have risk? And what are the existing frameworks? So those of you who've been very involved in impact investing and sort of sustainable investing over time, know these acronyms. There's a C of them. It's TCFD, it's SASB, CDSB, GRI, PCAF. There's a lot of them. What's useful from those? What should we pull into the SEC as a standard rulemaking? Or maybe we should defer to those standard setting bodies. Maybe the SEC should just say, well, we don't have any of the expertise, you guys figure it out. And then just say, companies, go comply with that. Or alternatively, maybe those things are somewhat lacking government accountability, or maybe their governance structures may not be right, or maybe their funding may not be right for investors, right? Maybe they're more interested in making it easier for issuers than for investors to use. And so to what extent should they pull from those existing standards, or to what extent should they say, hey, we're going to defer to them, if at all? Another thing is auditing and enforcement, right? We all know, as you pointed out, Kim, at the beginning, it's what you measure, but it's also what you're accountable for, right? And we all saw, in the post-Enron world and WorldCom, Sarbanes-Oxley come up with accounting and auditing standards and those types of things. What needs to be done here to make sure that financial claims and disclosures are accurate? And then the last thing is sort of what's covered. And I use as the what's covered, meaning the SEC traditionally regulates just public companies, public offerings of securities. And once you've done a public offering of security, you're a public issuer and you have ongoing reporting requirements. But what about private equity holdings? What about private debt, 144A debt? To the extent that, and I'll just pick something for a moment, ExxonMobil sells billions of dollars in private offering debt that comes due in 30 years or 20 years. What's the risk to the holders of that debt? What disclosures do they have? And right now, the answer is maybe nothing. And so should the SEC require something there? They've created the exemptions to the securities rules and laws. Maybe they should say, well, we'll condition it on additional disclosures related to the risks of the finances, perhaps their climate exposures. So with that, I apologize for the filibustering answer. So the big things, I think, so I wanted to give a little bit of overview of what those 15 questions were. And the two really big ones that I think are most impactful for investors to hear from. One is, what do you use and what do you want to use, right? And so to the extent that you're going about and you in your day job, maybe assessing risks and interests, maybe you have a certain view of the world, whatever that is, how do you get that information and what don't you get that you want? And so really importantly for that is what effort are you expending on this? What's the value to you? Are you spending a lot of time and energy trying to reconcile things? Do you call up companies? Do you try to negotiate things for them to change? So what do you use and how, right, is one. And then the second one, I think sort of flows from that, which is really basically like, what were you going to use this new stuff for, right? So you have your problems today, and relaying your problems to the SEC, we have this thing called cost benefit analysis and regulation. It basically says, hey, we want to minimize the burdens of getting the disclosure while maximizing the benefits. And that's wonderful. But the baseline today is a lot of investors are wasting a lot of time, spending a lot of time, working very, very hard, trying to get climate related information and not getting it. Investors who are having those fights, engaging in that effort, sharing that information is really valuable. And then the next part is, how much better does your life get? How much more accurate can you be with your estimates if there was comprehensive, reliable, standardized information? And with that, I will defer it over to the others here on the panel, and happy to answer questions as we go forward. Thank you.
Thanks so much, Tyler, and we'll come back to some of that because it's worth highlighting. Our next panelist, Isabel Munilla, if I've pronounced that right, is the Director, U.S. Financial Regulation of CERES, CERES. Previously, she spent 10 years working on SEC disclosure rules on the oil, gas, and mining sector, leading Oxfam's legal and advocacy strategy. Before that, she headed up the U.S. chapter of the Global Transparency Coalition, and before that, spent another 10 years at the World Resources Institute. Isabel, please introduce us to CERES for those unfamiliar, and tell us about its top disclosure priorities and the reasons investors might want to endorse them.
Sure. Well, thank you very much. And thanks so much for the invitation. I'm so happy to be here. This is obviously a historic moment for our world and our country. And I think we absolutely need investors to chime in right now. So couldn't endorse what Ty said enough. So in terms of CERES, we're a nonprofit organization. We're about 30 years old, and we focus mainly on the financial business case for sustainability. We work with a large company network, a large investor network, and our approach is really to identify and enhance and build best practice. So in our investor network in particular, we work with about 200 investors managing about 30 trillion in assets under management. And we've been working on climate and ESG disclosure for a very long time. We helped to found the Global Reporting Initiative, and we work with Cindy and investors to successfully petition the SEC to adopt the climate disclosure guidance in 2010. But we're here to talk to you because I think the challenge for us is that companies have made really big investments in voluntary reporting and disclosure over the years. And we've been at the front of that investment, at pushing that investment and trying to make the most of it, of supporting it. So we really believe in that effort, and we want to maximize those voluntary investments that have been made over the years. But the problem is that the information just isn't comparable, consistent, or decision useful in the face of this climate crisis. It's just not giving us enough to move capital fast enough. So we as an organization, we just see climate as a systemic risk. And actually after our work on the SEC 2010 guidance. And later we began the development of what we call the Capital Markets Accelerator series, where our big focus is really to look at climate as a systemic risk within capital markets and to move market structures to address that risk. So I think we could agree that right now, the lack of information on climate risk is a market failure, and the climate is a market failure. And so part of what we're hoping to do in a whole range of pieces of work, including bank prudential supervision and a whole range of other work we're doing with financial regulators, we're helping to address that market failure. So on this in particular, for the SEC, as Ty mentioned, it's really, really important that the SEC understands that investors are the ones who are now bearing the high cost to collect and find climate risk information so they can take advantage of these investment opportunities in the energy transition, but then also protect their assets, especially pensioners and savers. So we really believe very strongly it's in the SEC's mandate to address this inefficiency. And as you're thinking about talking to the SEC, that's one piece I would recommend you think about, that it is an inefficiency. The burden is on investors now to try to collect this information. The cost is on you. So that's why we support the mandatory disclosure requirements as a best practice. So in terms of what our disclosure priorities are, I just say that they stem from investor demands for information. So we're a founding partner of Climate Action 100, which is an investor-led initiative of about 600 investors with about 54 trillion in assets under management. And it's focused on ensuring that the world's largest corporate greenhouse gas emitters take some action on climate change by improving governance, cutting emissions, and then strengthening their disclosures. And I'll drop a link in the chat in just a moment on that initiative. And then we're also a founding partner of the Investor Agenda, which also supports investor action on climate change, including disclosure, and the Net Zero Asset Managers Initiative, which is a group of 87 firms representing about 37 trillion in assets that set 2050 decarbonization commitments, interim targets, and they agreed to publish annual disclosures following the recommendations of the Task Force on Climate-Related Financial Disclosures, which I included just at the beginning of this session, a little note on that, with some other commitments. But these initiatives have in common the need for a few key pieces of information. And there's a lot of information we care about at the SEC, but we have a limited amount of time to get a few disclosures done. So in terms of our priorities, we have these TCFD disclosures, as I mentioned, the Task Force on Climate-Related Disclosure recommendations. So we want the SEC to adopt those and mandate the disclosure of those recommendations. And those recommendations cover governance, disclosure on governance, the organization's governance on climate-related risks, strategy, including how you plan for the scenario analysis in the future, what it looks like, risk management, and then metrics and targets. So what we hope to accomplish is we're recommending that the SEC goes a little further than that, starts with that framework and then adds a little meat to the bones. We'd like GHG emissions, scopes 1, 2, and 3, we'd like those audited. We'd also like some kind of standardized scenario analysis disclosure. And we're providing, and I'll provide in the chat, we have a short letter that spells out a few basic minimum asks to the SEC. And I can talk about that a little bit more later, Kim, on how to sign on to that, and I'll put the link in the chat. But we're also doing a much longer letter that goes into a little bit more detail on other issues that we really care about as series, including water risk and deforestation risk. But maybe I'll stop there. Kim, but that'll just a quick overview.
Great, thanks so much. So last but certainly not least, Professor Cynthia Williams holds a chair in business law at Osgoode Law School in Toronto and also teaches law part-time at an Amsterdam law school, whose name I can't pronounce. Her academic writing is extensive and impressive. She previously practiced law at Cravath in New York. Cindy engages in policy work through the Network for Sustainable Financial Markets, the Climate Bonds Initiative, and the US EPA's Environmental Finance Advisory Board. So Cindy, in 2018, you petitioned the SEC for a rulemaking on standardized ESG disclosure. signed by investors and organizations representing more than 5 trillion in assets under management. Are the arguments different today than in 2018? And why might mandatory ESG disclosure succeed now when it did not previously?
Thank you, Kim, and thank you very much for pulling this discussion together. The 2018 petition was something I was asked to write by a group of civil society and better markets participants in Washington, because after the Trump administration came into power, they felt like there were people at the SEC who were starting to understand that global markets were moving in this direction, and that they didn't want internal staff at the SEC to lose momentum. So while it seemed like a really sort of hopeless project, I thought, well, that makes sense. We shouldn't just play defense for 4 years. Let's set out what we think really the SEC should do. And that petition emphasized what mainstream investors are now saying about the way they are incorporating ESG and climate into their portfolio constructions, analyses, and voting. And I think what's different now, one, we have a majority of the commission that have shown an appetite. They are going to be regulating in this area, which I find, almost thrilling, having written about it for 20 years at least. But second, we just see an avalanche of government recognition across the world, including in the US, recognition that these are financial risks, and that for many individual companies, these are significant financial risks. These are also systemic risks. And we just saw, on Friday of last week, the White House executive order on climate and financial risk, which is taking across the government approach and saying for almost every type of financial institution, right? Banks, asset managers, insurers, we want you, government agencies, to determine how to measure, manage, and disclose these risks. So it's just a very different factual context. I could go on and on. The only on and on I want to go is to also mention the International Energy Agency at the beginning of last week issued a roadmap to net zero energy by 2050. And that roadmap, some of your participants may know the International Energy Association has been looked to by many companies around the world as a solid kind of future demand projections for fossil fuels, and a very clear way to do scenario analyses for the future in this transition. The IEA, as of Monday of last week, said we cannot have any more oil, gas exploration, nor can we have any more coal mines being built or mines being extended. So, it's just a very different world. I think we have enough players understanding the urgency that there will be actions taken, and your investors have agency here, as do many of us, but agency to try to make sure that we at least use this lever, disclosure.
Wonderful, thank you. So I guess there are lots of oh my God moments floating around. Before we go further, just to level set, if you will, if someone works for an asset manager, who at that company would typically write a letter for the organization to the SEC? And for individuals, so it's one question, and then for individuals who are writing their own personal letter, if they are employed at an asset manager or the like, who should they check with just to make sure that they can do that without adverse consequences? Tyler, please.
Yeah, I'll explain the SEC comment process, because not everyone's terribly familiar with it, particularly if your day job is in finance, not necessarily in dealing with the SEC. So a couple of things. First off, the SEC's comment process is sort of open. They do take anonymous submissions, they take other submissions, they value sort of expertise sort of somewhat equally. So it is, in some respects, as we've all said, investors carry more weight with the SEC. You're the target audience in terms of their investor protection mandate, but they also have other mandates, which is fair and efficient and orderly markets and other things, but you play a key role there. So one is the value of those comments. Process-wise, look, larger firms typically will have a general counsel, a compliance officer, maybe even a government affairs official. Typically, they may hire outside counsel, or they may stay in-house, craft up, vet a comment letter in the same way you would sort of any submission to a regulator. At the end of the day, these are submissions to a regulator to effectuate policy. You don't want to be, sort of sharing information that says, hey, by the way, this firm is violating the federal securities laws, or those types of things. And but those types of issues do rise up. And so one of the things I think is important is, before anybody considers writing a comment, recognize that your firm probably has a strong view, and it shouldn't really have to go without saying that if you have thoughts, and you want to sort of share them, you should run them by your employer, to the extent that, hey, I would urge you to say it's better for your employer to weigh in than it is for you on your own. If you feel strongly, also recognize that, like, you may want to comment in a personal capacity, and that may be fine too. But also recognize that this is a submission to a governmental entity. And so, one, you want to be sort of forthright in what you say and accurate and all of those wonderful things, but also recognize that, what you say to your government, you're going to be held accountable for your firm. As I said, the SEC does take anonymous submissions, but it's not advice I would want to suggest to trying to sort of make a submission without running it through your firm. And so the SEC does take a lot of submissions. And then frankly, we have seen it repeatedly over the years, where a single person may be responsible for a trade association letter, helping form a trade association letter. They may be responsible for their own firm letter. And frankly, sometimes they may be responsible for their own individual letter. And again, it's really all up to you how you want to do the submissions. It's on the website. In the chat is the link to the SEC's 15 questions. You can go there. Very, very simple. You can do it through an online submission, or just frankly an email to the SEC. Either way works. But just as a process matter, I would say, look, some of the best letters tend to be from retirees. There's a reason for that, right? The expertise, but yet the freedom to maybe not necessarily be viewed as putting their firm at risk or saying something that's adverse to their firm's interests. And so depending on where you are in your career, your firm's engagement, your firm's interest, I think the more letters, the better, the more comfortable you can say. Also recognize there's 15 questions, sub-questions. I think it's 63 items. Answering just one tiny thing is itself extremely valuable, because you never know what the issue is that the SEC may be wrestling with, and you may have that perspective on that one issue. So even if your firm is like, we're not going to try to boil the ocean with all of these questions, even if it's one very narrow topic, there's extreme value to it. I have personally, when I was in the government, worked on those issues, and I've seen it done as well.
I'd actually like to add to that for firms that are advertising their expertise, either in a fund or broadly for the whole firm, that they're impact investors or sustainable investors or ESG investors, whatever the appropriate label is, putting in a letter is part of your good citizenship, if you will. And also, you or your firm has expertise that really is needed. In my experience, investors are a very disparate lot, so it is harder to corral their voices. And frankly, it's why I've tried to step up in some way organizing this Zoom, and we hope to use it beyond this to encourage people to say, I have this experience, and you the SEC should hear about it, and this matters to me.
One quick thing about where we are procedurally. So the SEC is at a stage where they did a request for information. This is not a proposed rule. So they're basically saying, what should we put in a proposed rule? So as I look at it, this is the opportunity to maximally affect the Overton window of what gets done here. So to the extent that you have an interest in anything happening in this space, now's really the most impactful moment for you to shape whether or not or how that happens. Because once we get to a proposed rule, there's Administrative Procedures Act, there's notice and comment. And as that comes out, the SEC is actually bound to a path at that point. So they can tweak things within it. But if they say, for example, in a proposed rule, we are going to delegate to a third-party standard setter, then it's going to be really hard for them to not. If they say instead, we are going to put detailed line item disclosures where there's sort of number answers, and as Isabel alluded to, like TCFD sort of prose answers, then they're likely going to be bound to that framework going forward. So if you have views on any of that, I would say now's your chance, because the scope of issues is going to narrow very, very quickly by September, October, November this year when a proposed rule comes out, because then we're only going to be fighting about what's here. Right now, it's what you tell them is the answer to these questions.
Thanks, Tyler. So Isabel, you've been coordinating with a number of public interest groups in DC, and I understand there is a Zoom meeting with the newly confirmed SEC Chair, Gary Gensler. Could you add to Tyler's comments about views from inside the Beltway? And perhaps as part of that answer, could 14 of the 15 questions are about climate disclosure, and only one explicitly refers more broadly to ESG. So what might the SEC's work sequence and timing be on human capital and diversity issues, or any other issues that are circulating in Washington and among investor groups?
Yeah, no, great question. I think this is really important. And I think, Ty covered it to a certain extent. I think, climate is a top priority. Mr. Gensler is focused on it. He has changed his procedures somewhat. So he's going to have, his economists at the front end of this process, both on the climate side and on the human capital side, to make sure he kind of gets the best draft at the beginning of this process, rather than what usually happens where the economists come in maybe a little bit more towards the end to do the economic analysis. So that's all to say that a little bit of backroom baseball, that they're lining up their soldiers to do the best job possible, right? And so on climate, climate's going to come out first, but human capital rule is not far behind. And I think what's great to see is that there's a real recognition that human capital is related to climate risk. So if we look at the just transition issues, if we look at the workforce issues related to an energy transition and the reporting around workforce that we're going to need to ensure for those organizations like Ceres that cares about a just transition, and we have many companies that we work with that care about it too. They care about what's going to happen to their workforce in the future and how their workforce investments relates to their climate strategy and climate risk management strategy. This is to say that these human capital disclosures are somewhat captured in question 15. So, and what we've heard from the SEC is that they want to hear from us now as well on that. So you have, your questions 1 through 14 that generally cover climate. And then you have question 15, was a bit of a grab bag. So in there, you can put things in about human capital disclosure if you wish. You can just flag things, and you'll have another bite at the apple later in a human capital disclosure rulemaking. But for example, in that section, we're going to talk about workforce disclosures. We're going to talk also about political spending transparency and policy engagement transparency. I know some folks are going to talk about tax transparency and a whole host of issues that the SEC is grappling with, where frankly, they can actually use public input without there being, as Tyler said, the confines of a rulemaking, which actually constrains them a little bit to be more flexible in taking in all of these comments. So I think if you have things to offer related to those other issues, but especially if you can link them to climate, you can drop them into that question 15 answer, and they're very happy to receive that. But that's all to say that that's not the only bite at the apple. You can also send in comments to the commission on human capital issues and these other issues, political spending, political lobbying transparency, really at any time. But in particular, they're trying to close this comment process so they can begin processing these with a view to producing a climate draft rule and a human capital draft rule in the near term, within 6 months, right, Tyler? Probably around then. Yeah. And just in terms of the timing, just quickly, Kim, I think it's also important to keep in mind that there are some political timeframes. Keeping an eye on the midterms, there may be some political shifts. So we know that from a political standpoint, the commission really wants to get some legally defensible climate disclosures done in the spring next year, if possible, with there's a risk of litigation. That's just the nature of the game. And they want to be prepared for that. So even more so, I would, second and third, the recommendation that if you have data or analysis or your reflections to add about your own burden as an investor right now, what does the status quo mean for you in terms of your own cost in accessing that information and what you're missing and what you need in detail. And as much as you can quantify that, that's what the SEC needs, because they'll need to assess the status quo. What are the gaps in information and who are the beneficiaries or not of those gaps? And then they'll have to provide an analysis at the end of the day with the final rule of who's actually benefiting from the disclosures that they're mandating, as specific as they can get. And that will actually help their legal defense of the disclosures that we want. So just wanted to make a link to that through line.
Great, thank you. So I want to turn over to you, Cindy, with a two-part question. Is it more important to answer specifics of the 15 questions as to how to obtain disclosures on climate, or is it still important to answer the essentially unasked question of why investors need better disclosure? And then as part of that, the concept of materiality underlies much of this. So if you care to step into that discussion and clarify how it's gotten misinterpreted and how it should be correctly legally interpreted, please comment on that or on anything that your fellow panelists have said.
All right. Well, thank you very much. I think that Tyler said it well. If you have insights from your practice and your investment work to date that go to one specific question, then that's the one to write about. I do think we hear a lot, we have a lot of research reports about investors saying we need consistent comparable data. I think the more specifics the SEC can hear about that from actual investors, the better. Now, about this materiality business. There has been, I would consider it part of the pushback talking points to suggest that the SEC's authority to seek disclosure is limited to those particular items that the SEC can say individually are financially material to a buy or sell decision of an investor. And I would say that, first of all, Commissioner Lee has a fantastic speech from yesterday to the CFA, Certified Financial Analysts Association, and other auditors on misinterpretations of materiality. And she clearly takes on this one, right? The SEC has broad authority to seek disclosure as necessary or appropriate in the public interest or for the protection of investors. That's about a direct quote from Section 14 of the 34 Act, which goes to proxy disclosure. What information do investors need before they make a decision on who's going to manage the company for the next 12 months? Right. So the standard definition of materiality is information a reasonable investor would consider significant in the total mix of information available. That's the definition that is used to filter some of the line item requirements for disclosure. It's also the definition that defines a cause of action for fraud, but it's not a definition that limits the SEC's authority. And I would also conclude by saying, let's pay a little attention. A, who are the reasonable investors? Questions I always ask in my securities classes, and we debate about that. Are impact investors reasonable investors? Yes, of course. But I also think we should pay attention to this concept of the total mix of information already available. Is this information that we're talking about already available in the total mix? In many cases not, and not in a form that is useful for investors.
Thank you. Some of this has been hinted at, but I warned each of you that I'm going to be a devil's advocate for a moment, out of fairness, but also out of having sort of better arguments for those who agree with me. What are some of the arguments against mandatory climate and ESG disclosure? Anyone want to take that on?
Well, so I'll apologize if I've got a printer going in here in the background, but I'll say we've actually heard these arguments now for a long time in various types of disclosures, be it political spending or climate disclosures. And we actually just recently heard them very recently in the House Financial Services Committee hearing on climate and ESG. And we heard a couple of things. One, we heard it puts US companies and US issuers at a competitive disadvantage worldwide. That's an interesting one to make, considering the rest of the world seems to be moving slightly ahead of us on some of these issues. So that's one perspective, international competitiveness for the issuer. Number two is, we always say we want more public companies, more IPOs, more public capital formation, most robust capital markets in the world, all of that. We're requiring putting more burdens on corporate issuers is going to push more into the private markets. So you're going to have even less transparency. If you put more burdens on public companies, fewer companies are going to go public, more will stay private, more will go private. And interestingly, there's some data to back that up. We've seen fossil fuel companies, for example, now less financed by equity and more financed by debt. We've seen more of those assets become private equity held assets in sort of traditional large fossil fuel companies. So we actually are seeing some of that. And the question is, now what do you do about that? And so I would say those two seem to be the most that resonate. The third I would just say is the corporate resources. Gee, this just costs a lot of money. It's a lot of time. It's a lot of headache. Nobody has the expertise, and getting the expertise is really expensive. So those are the sort of three from the issuer side. There is an investor argument on this, which is essentially, again, observed by facts. We have seen a lot of money flow into ESG conscious investing, not just ESG funds, but also even general fund firms that may not say this is an ESG product are saying, and I'll use, some of the largest asset managers in the world say they integrate climate and other ESG factors more broadly into all of their portfolios. And so to the extent that there is that, many are saying, well, look, it's not lost on us that ESG investments pay better, higher fees. It's not lost on us that debt offerings that claim to be green debt offerings or sustainable debt offerings tend to get better pricing and more investor demand these days. And so there is a concern that there is a massive swath of greenwashing, that all of this, it doesn't mean anything. Nobody's really doing anything. Nobody really cares. This is at the end of the day all about dollars and cents. And the rest of this is a marketing play. And so I would say that's the investor argument or the anti-investor argument. And the others are really more on the burdens on corporate issuers. Obviously, you've heard my explanation. I'm somewhat dismissive of most of them, but there's also kernels of truth in each, right? And so we need to make sure that as the commission moves forward with not just this rulemaking proposal about climate disclosures, but about, for example, if you're an asset manager, if you're a registered investment advisor, are you going to have policies and procedures to review and consider these things? I don't think the SEC is going to tell you to manage to net zero, but the SEC may say, yeah, you have to look at this stuff. You might have to, if you're going to claim you're going to be as sustainable, you ought to have policies and procedures to review the assets that you buy and the strategies you take with respect to those assets in terms of voting and valuation. So I, again, apologize for the filibuster, but I am a Senate staffer at heart.
I'd like to hear Isabel or Cindy have further comments, but I neglected to try to generate more Q&A in the Q&A function. We would like to raise up any questions from the audience. And I'll also mention that Tyler has to leave us early. He actually has a Zoom or something with Commissioner Lee. So when he disappears, that's the reason why. So Isabel or Cindy, do you have anything you want to add on the devil's advocate, why there are arguments on the other side that absolutely should be considered and try to figure out solutions for at least?
Cindy, do you want to hop in?
Yeah, I would say one of the arguments I get very often when I discuss these matters is, look, the private markets are working. Voluntary initiatives are being developed. And if we pass regulation, it will stop those developments and in the tracks. So it's both a question of, is the private market doing enough so that regulation isn't necessary? There's no, market gap. And will mandatory regulation mean that further developments in the private market for sustainability disclosure won't happen? So it'll sort of slow things down. And of course, legislation is not as flexible as private initiatives. So, it's not an unreasonable concern.
Isabel, do you want to add further to that?
Yeah, I think one of the, I would just flag the competition point and the international competition point. I think one of the key areas that we should be looking at and commenting on is this notion that, the US is not going alone on this. I mean, we are not flying solo on this issue, as with maybe some other areas where we led. So for example, I worked on the oil and gas and mining payment disclosure rule for the last decade or so. That was where the US adopted a rule as part of the Dodd-Frank Act in 2010 and did go first. And then other markets slowly caught up to us and have gone far beyond where we've gone. And that included the UK, the EU, and Canada. And I think in this instance as well, I think it's important to note that if US disclosure doesn't capture some of our listed companies, other markets are going to capture them. So the question is, what is the SEC's role to create some consistency around that? Because for sure, we're not going to get all the disclosures what we want in the US, but we should get some minimum level of consistency across these markets. And they're already moving. The UK is already moving with its mandatory disclosure rules, and that's the second largest capital market in the world. We have a ton of cross-listed companies. Canada is also starting to move forward, a lot of cross-listed companies in Canada. So we can't discount the fact that the train has left the station on mandatory disclosure. Other markets are moving. So we just need to get in there and say, what are the most important disclosures that we want first? And that's my pitch, actually, Kim, for the letter that I'm going to put into the chat. So this is a statement of essential principles that we put together. It's sort of an unbranded letter, just to help folks as you're thinking through what are the most important things that we believe the SEC should probably do as it's thinking about climate disclosure. We've just harnessed a few of those. We're going to say more in more detail in our own letter with our own brand, but we just wanted to share this with you. Please feel free to reach out to me if you like. And I think Kim's going to share our contact information if you have any questions about that. Also happy to talk through some of the individual disclosure asks. But I think, for us, it's really important that we keep this time frame of, some folks say we have 9 years to avert catastrophic climate change. We actually have something that I think Greta Thunberg says 7. I think people say less. So the speed at which we need to shift capital flows is dramatic. So it's very important that we land on some minimums. And if you feel like you're landing on some of these minimums with us, we'd love to know, and we'd love to help you communicate that to the SEC.
So I have put in the chat a follow-up email, and we'll make series sample letters and some other sample letters available. Cindy, do you have any 1-minute comments? Otherwise, I want to turn it over to Tatiana to talk about our host organization, Impact Capital Forum.
I would just like to encourage people to try it out. I took a huge piece of blank paper last night, put it on my kitchen counter, and sketched out my argument. So, okay, let's do some, blue sky thinking. I think Tyler's point that this is the time to have the broadest conversation and contributions to the SEC is really worth keeping in mind. So thank you. And I will keep in touch with Kim, keeping in touch with all of you, making sure that we get the strongest record we can here.
Thank you, and thank you to both our panelists. And again, Tatiana, please take a few minutes to talk about the very worthwhile Impact Capital Forum.
Yes, thank you so much, Kim, and thank you, Cindy and Isabel and Tyler. I guess he's gone. Thank you for this really fantastic panel. It really is a historic opportunity, and we're grateful for you sharing the depth of your expertise and your actionable guidance. So just a few words on Impact Capital Forum for those of you who are new to us. We're an individual member organization with the mission to advance the social finance sector by providing a platform for collaboration and thought leadership. We host events throughout the year on the most urgent topics to impact investors, social entrepreneurs, asset managers, and the broader community of impact-oriented business professionals. Next month, we are hosting an informal networking lunch, a panel on donor-advised funds, and also, I'm really excited about this one, launching our Gender Lens Investing series with the first panel on mobilizing capital for gender lens in emerging markets, featuring some leaders in that space. Recordings of our past events are available to all our members. If you are interested in becoming a member, you can reach out to me directly or email info@impactcapitalforum.org. I dropped that into the chat. And if you have additional questions about the public comment process on SEC disclosures or other topics discussed today, Kim kindly offered a follow up with her directly as well. And that email address is in the chat, investorvoice@highwaterwomen.org. Thank you again so much for joining us. And thank you to the panelists and our attendees. We hope to see you at our future events. Have a great day.